gives me tremendous pleasure today to welcome you all. We are delighted you have joined us today as we launch the first tranche of Kenya shillings 4 billion of our 10 billion bond, which has a green shoe option of 2 billion, implying that on aggregate terms, we can go up to 6 billion shillings for this tranche. Family Bank is now 31 years old, and over this period, we've grown from strength to strength. But even as we've grown, we've always known that our growth story is not just about us. Our journey and our story has always been about the customers, about the communities, about the investors, about the customers and the staff who have placed so much trust on us. The growth of Family Bank, therefore, heralds what you can call a high mark in this market, because if you think about an enterprise that is 31 years old, has achieved what we have achieved, and on comparator terms, then you look at us vis-a-vis the others in the industry. It's quite fascinating in itself. In 2013, Family Bank was feted at the Think Business Kenya Bankers Association Awards for its outstanding performance in financing the small and micro businesses. This is the sector that houses millions of Kenyans, and we are very happy in terms of the financial freedom and empowerment which we continue to impact across the different communities. Not a long time ago, 2014, we were voted the best bank to work for in Kenya. We need to appreciate some of these accolades. And for the last 2 years in a row, we've been voted the fastest growing bank in Kenya. Perhaps looking at the bank's compounded annual growth rates on different balance sheet parameters, Family Bank might as well be the fastest growing bank in Africa, if not in the world. This momentum is expected to continue and underscores our excellent performance, with profit before tax going 8-fold to 2.6 billion within a period of 6 years. And for the last 7 months to 31st July 2015, our profit before tax, which was also audited, stands above 2 billion shillings, putting us on course again to declare a significant jump in profitability of the company. Our board will be listed in the Nairobi Securities Exchange. This makes this debt instrument very liquid.
The bank has really grown over the past 5 years, from the deposit, loan book growth, and more importantly, the bottom line, and adding into the shareholder value. It is worth noting that this growth has been delivered primarily deploying the equity capital. And always it's advantageous to leverage the balance sheet to enhance that the growth momentum continues. And that's what we are launching out today. We aim to close this on 21st of October. Those will be 2 weeks. We'll do the allocation on 22nd, the announcement date on 23rd. Then the settlement will come out on 26th, and we envisage to list and start trading these particular notes on 4th of November.
At 31, Family Bank is now of age, and we feel we are now ready to play in the big league. Our 5-year strategic plan assumes our having a very strong presence in the region, as well as playing in the big league in the local market as a Tier 1 bank. To do this, the bank has embarked on a fast growth trajectory, which will require a lot of capital. When you look at the major components in terms of how we have grown, and we are growing at least more than twice what the industry is doing, that in itself requires a lot of capital, and that is why we are coming here. And as you all know, as a bank grows and continues to take more and more deposits, the central bank regulations require that the shareholders, the owners of the bank, add more of the capital. So this is part of the reasons why we are coming to the market in order to strengthen our capital base as demanded by our growth.
Being a multi-currency bond, is there an indication of where the maybe dollar rate would be if you're to put in dollars, at what rate you'd be given? Because I know for a local currency and multi-currency bond features, they're usually different in terms of pricing.
Well, the dollar component, we are pricing it at 6-month LIBOR plus a margin of 3%, or even better if we should be able to get that.
Why would I rush to invest into this when current interest rates are much higher?
The growth momentum has been quite significant, and always entities have to continue delivering returns to their shareholders. So you have to maintain that growth momentum by leveraging on the debt. Debt might be perceived to be expensive, but always equity capital is very expensive, because shareholders today, I'm very sure, will be looking for return on equity of, say, 30% or above 25%, which is very expensive. If you deploy that money today, in 4 or 5 years, the shareholders will come back knocking. We gave you the money, where's the return? So if you leverage it to the balance sheet, it's still a win-win situation.
Basically, if you look at the macroeconomic fundamentals, the inflation is tracking below 10%, and that has to have a bearing on how these sort of instruments are priced and so on. But more importantly, when you embark on a program of financing a bank, you don't stop or veer away from your strategy because the interest rates have suddenly hiked, because then that means that in fact you give up your strategy. And when you have a strategy and you believe in a strategy, you follow that strategy and execute it to the rest. So we are not really terribly worried about the interest rates that we are coming when the interest rates are high, because also we have a whole basket of products that in fact, whatever it will be priced at, we should be able to lend that money at a positive margin, maybe not as wide a margin as we would like to, but it will still be a positive margin. So to that degree, we are feeling very confident that, this is just as good time as any other. Because